Is a home a good investment? When is doubling your money not such a great deal? And how can you improve your finances by conducting experiments? We'll answer these questions and more on this, the 76th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Well, in our last episode 75, we took a look at the difference between average annual returns of an investment and annualized returns or compound annual growth rate. And maybe not the sexiest of topics, I don't know. I kind of like getting into the math and the details, but I get that it's not for everybody. But it's, it is important, maybe not all the details, but at least conceptually understanding that you can't simply take returns over a number of years, good years, bad years, add them all up and divide by the number of years. It doesn't give you a meaningful number because volatility reduces your annualized returns, and so you have to figure out the compound annual growth rate. And I mentioned that there are a number of ways that actually comes in handy beyond just, say, trying to figure out the annualized returns of the S&P 500. One of them is trying to figure out really whether any investment is a good one, including a home. And this is sort of a topic that gets debated. Is your home, should you even think of your home as an investment? Is it an investment? Is it a good investment? Some say no. Others say, well, if you look at homeowners, their net worth is usually a lot higher than folks that rent. Of course, you have cause and effect, whether the homeownership caused the increase in wealth or not. So today, I thought we would do something a little different. I'm gonna tackle this issue rather than sort of looking at it from the 30,000-foot level. I'm gonna dive into some details and actually use the first home that my wife and I purchased. We bought it 21 years ago. And then sold it about 10 years ago. I've pulled out the numbers. I actually went back and got all of our HUD-1s from the sales and crunched some numbers, and I'm going to walk through how we did on that investment and kind of conceptually how I work through it. And I think you'll be surprised by the results. Before we get to that, quick sort of money tip of the day, and that is something that I'm working on too. You can experiment with finances, and it's something that I think can come in handy. For example, if you're thinking, "Gee, should I get rid of cable to save the money, or can we live with one less car, or do I really need Starbucks every day?" Whatever it is for you, try it for a month. Go without cable for a month. You don't have to cancel it. Just experiment. And I really think you need a month. I think if you can do it for a week, maybe, but I really think you need a month to experiment with a change in your life, and see what you think. You may find that not only do you not miss it, but in fact your life is richer without it. You never know. And this can also be a way to deal with, for couples, if you have a disagreement over something, and you can't just come to a common ground with some issue. Try it one way or another. Experiment for a month. I'm working on this sort of in my own life in terms of business and how I manage my day. And in fact, if you listen to this podcast on the day it's published, I will actually be on a fishing trip in the middle of Minnesota. And I'm going to use that week in part to kind of figure out what kinds of sort of lifestyle experiments I want to undertake the rest of this year in terms of productivity, how I spend my day, how I manage it, how I plan for it, where I work, when I work. But the same thing can be done with finances as well. And so just a thought, you might want to come up with some experiments, some trial periods, things you can do for 30 days. And you might find that what you were maybe fearing wasn't so fearful after all, and maybe even enriched your life in some way. So that's the money tip of the day. So now on to the main topic. So my wife and I bought a home back in 1993. It was our first home, and it was in Northern Virginia, which is an extremely expensive part of the country. Not the most expensive for sure, but I've got to believe it's up there. And we bought a 30-year-old home, had 3 bedrooms. It was a single, it was a ranch, but it did have a basement, and fairly small property. It was less than a quarter acre of land, and no garage, a small little driveway, and we loved it. And we paid $190,000 for it. Now, in Ohio, where I grew up, that same home would have cost $100,000 or maybe less in 1993. But we paid $190,000 for it, which at the time just seemed crazy. But that's what we paid for it. And fast forward 11 years, 2004, we sold it for, drum roll, $435,000. Now that just to me seems mind-boggling. We went from $190,000 to $435,000 in 11 years. That just seems like a home run. How can that not be a fabulous investment? Well, we're going to walk through it today, and we're going to look at just how good of an investment that turned out to be. And I'm going to kind of walk through it in some detail and kind of peel back the layers of this issue a little bit for you. One step at a time. And so let's just start with, we bought it for $190,000, we sold it for $435,000. On just those numbers alone, what would be the compound annual growth rate over that 11-year period? And if you listen to the last podcast, you know that in Excel, that's pretty easy to figure out. The formula is fairly straightforward, and you take your starting and ending numbers, you divide them and take it to the power of 1 divided by the number of years, in this case 11, and then take all of that and subtract 1 to turn it into a percentage. And what you get is a compound annual growth rate of 7.82%. And by the way, if you're interested in the math, I'll include that in the show notes. But 7.82%, which may be a little surprising to you, but that's what it actually comes out to be. What that means is, if you had $190,000 and you invested it for 11 years, and each year you received 7.82% return, after 11 years you'd have $435,000. So when you look at the numbers, boy, a jump from 190 to 435 seems huge. Although, at least in my mind, when you see a compound annual growth rate of 7.82%, that's not overwhelming. We think of long-term stock returns of 10%. Now, one thing to note is that return would be tax-free, right? Because of we lived in our home, and we would have qualified for that tax benefit. So that's pretty significant. It would be tax-free, but still compound annual growth rate of 7.82%. Now, unfortunately, it's not quite that easy. So there are a number of things that we need to sort of factor in. And let's kind of walk through them. The first is the costs of buying and selling a home. It can be very expensive. I think most folks, hire realtors. We did. You certainly can try to sell the house on your own, and some do. I can tell you, with the real estate that I own, the rental properties that I own, we do try to sell them on our own, usually to the tenant. So if a tenant wants to buy, we'll enter in a transaction and sell it without a real estate agent, and it saves us a lot of money. But in the case of our own homes that we live in, we used a realtor. And then, of course, when you're buying, you get a mortgage, there are transaction costs, and maybe the seller will pay some of them, depends on the market, whether it's a buyer's market or a seller's market. So I went back to the HUD ones and sort of crunched some numbers. And for our purchase, we really only had about $1,000 in extra costs because the seller, it was a buyer's market, so the seller paid some of our closing costs. But that bumps up the cost from $190 to $191, not a huge difference. But on the tail end, we had about $35,000 of costs, which included real estate fees of 6%. There's some transfer taxes, county taxes you have to pay, other fees. And then we spent a little money fixing up the house to get it ready to be sold. Not a lot, but it adds up. And so just on those sort of transaction costs, I'll call them, we have an initial purchase, $191,000, and our $435 drops to $400 because of the $35,000 in expenses. And so just that alone drops our compound annual growth rate from 7.82 down to 6.95. Still not a bad deal, tax-free, gotta love that, but we've already shaved off almost a full percentage. We're down to 6.95. That's a pretty significant drop, and unfortunately, we're not done. So what's next? Well, we did improve the home while we were in it. We remodeled the kitchen. We did it ourselves with the help of my father-in-law, and we had the custom cabinets built by my wife's uncle, who was a cabinet maker, and so we got a really good deal on what were amazing cabinets. And we redid the main bathroom again. I did the work with my father-in-law's help because left to my own devices, it would have been a disaster. And we converted a deck to a 3-season room, and so that was probably our most expensive improvement. And while I don't have the exact dollars, total improvements, my best guesstimate, and this is going to be pretty close, was about $30,000. So I kind of add that to the cost side of this equation. So that bumps the 191 up to 221. That's our sort of investment in this property, if you will, because of the improvements. And so if you run the numbers on that now, we're dropping significantly more now because we're starting with a cost of $221,000. It's not looking quite as good already, and a net proceeds at the end after expenses of $400. That drops our compound annual growth rate to 5.5%, 5.54% over the 11 years. So, we started at 7.82. We're already down to 5.54. So this investment's not quite looking as good as it did. And unfortunately, we're not done. So now what's the next thing we got to factor in? Well, maintenance. You have to repair things in your home. We didn't have any major maintenance issues. We did have to replace a water heater and just the normal stuff that happens and things break and you have to fix them and it costs some money. And I estimated the cost of maintenance at $1,000 a year, which is less than $100 a month. But that, of course, over an 11-year period adds up. That's another $11,000. So if we add that to our costs, we're now up to $232,000, and a compound annual growth rate drops to 5.08%. And we're not done. What do we got next? Well, we have to pay taxes and insurance, right? That comes out of our mortgage payment, but we make it every month when we pay our mortgage. And the taxes, the real estate taxes, if you itemize, are deductible. And so I factored in that. I kind of took the after-tax amount for the real estate taxes, and then, of course, the insurance. And boy, that adds up quick. Over 11 years, it was about $30,000. It was unbelievable. It's just part of a payment. You make it every month. If you're like me, you don't think a whole lot about it, but boy, does it add up. $30,000. And, that's not money you get back. It's not even, with an improvement, hopefully you increase the value of your home. With maintenance, you at least maintain the value. But with taxes and insurance, it's just money out the door. And so that raises our cost now to $262,000. So we're down to 3.92% for the compound annual growth rate. This is not looking all that snappy at this point. 3.92%. And so then we've got this whole mortgage business. We had a mortgage. We've talked about taxes and insurance. Now, if you think about the mortgage payment beyond taxes and insurance, of course, it's principal and interest. The part that goes to principal, that lowers the amount of your loan. So you'll get that back at the end when you sell, and it just reduces the amount of your loan that you have to pay back. But let's focus on the interest, the mortgage interest. Now, of course, it's deductible, just like your real estate taxes are, assuming that you itemize. There are some limitations, but certainly none that apply to us or probably most of you listening, unless you have a really large mortgage. So I added all of that up, kind of factored in the after-tax, and it was a bit of an estimate, but again, another shocking number. We paid $81,000 in interest. That's money out the door. We're never gonna see that again. And so that added more costs. that we put into this home to $343,000. So now it's like, well, wait a minute. We're down to a gain of about 60 grand and a compound annual growth rate of 1.41%. Boy, we started at 190 and 435,000. Things were looking pretty nice then. Now we're down to a compound annual growth rate of 1.41%. Now, for those of you following closely, you're thinking, well, wait a minute, Rob, it's not quite that simple because, you didn't pay $190,000 when you bought the home. You had a mortgage, as you've said. And so you actually got the home in terms of cash out of your pocket for a lot less than that. And so don't you have to factor in leverage? Well, you do, of course. And that's what we're going to do next. And again, leverage, all leverage is you think about it as borrowing to invest, right? So in the case of a mortgage, let's say you put 20% down, so you have 80% borrowed. And so that's a highly leveraged transaction. You can leverage investments in the stock market. You can buy on margin, for example, not something that I generally would recommend. But professional money managers do. REITs are oftentimes highly leveraged, real estate investment trusts. Hedge funds oftentimes use leverage. Leverage will, there's sort of a good and bad side to leverage. Leverage really can boost your gains when things go well, and it can sink you fast when things go bad. When your investments go south, leverage is like pouring gas on fire. And so it exaggerates. It exaggerates your gains. It exaggerates your losses. There are actually S&P index funds, S&P 500 and other index funds that use leverage to try to double the returns of the S&P 500. Great in 2013 when it was up 32%, not so good when it's down. So now in the case of home ownership, of course, we had leverage. We borrowed. And so I kind of walk through these numbers. I could do this in a much more precise way, but I think this will be good enough for our purposes today. So let's kind of walk through it. Well, our down payment to get into the home was $10,000. That's what we paid. It was about a 5% down payment. It had that small amount of fees we had to add to it, as I alluded to earlier. So it was about 10 grand to buy the home in terms of cash out of pocket. And then we borrowed the rest. So what other cash? Let's just look at the cash we put into this home. So that was $10,000. As I mentioned, we put $30,000 worth of improvements. So that was money out of our pocket that went into the home. Maintenance, as I mentioned earlier, that's another $11,000. And then we made mortgage payments. And again, I calculated this on an after-tax basis because we're going to get money back in taxes from our interest and our real estate taxes. But over the 11 years, and we refinanced. Of course, there are costs associated with refinancing, but when you add it all up, we paid about $132,000 in mortgage payments. Now, if you add all that up, total sort of cash into the home, $183,000. And as you recall, we sold for $435,000, had about $35,000 in closing costs. And so that brought us to $400. And then, of course, since we're factoring in leverage, right? Well, we need to back out of that $400 the mortgage balance that we had to pay off when we sold the home, right? We got to get rid of that. It was about $167,000, which is kind of depressing when I think about that. I know I'm throwing a lot of numbers at you. These will be in the show notes if you want to look at them in detail. But we bought it for $190,000, $10,000 down payment. So the first mortgage was roughly $180,000. And 11 years later, it was $167,000. On a 30-year mortgage, you don't make a lot of progress on the principal in the first decade. You really don't, unless you're paying extra on it. And of course, we refinanced, and that built some costs back in. Of course, it lowered our mortgage rate too, so there was a plus sign. But in any event, we had to subtract out the mortgage balance that we had to pay off when we sold our home, $167,000, and that leaves us with $233,000 after we pay off that mortgage balance. So we put in $183,000, and we come out of it with $233,000. This is with the benefit of leverage, and that does increase our return. Remember, before we factored in leverage, our compound annual growth rate was 1.41%. Not so good. Still ain't great. After you factor in leverage and you go through all of the costs and all the things I've just gone through, compound annual growth rate 2.22%. Yeah, still not fantastic. There are two things, though, that we need to factor in quickly. that make it at least a little better. The first is, the way I've formulated this, it's as if we paid all of these costs in year one. The down payment, which of course we did, but all the improvements, the maintenance, all the mortgage payments of $132,000. Well, of course we didn't pay those in year one. Those were spread out over an 11-year time period, and that certainly affects your returns, right? And so there is a way to calculate that, and it's fairly easy to do in Excel, and it's called the internal rate of return. The Excel formula is XIRR. I'll leave a screenshot of how I did that in the show notes. But basically, I had a column of the years that we were in the home just on an annual basis, so 11 rows. And I had for next to that the amount we paid, and I just sort of spread it out over the 11 years with the exception of the down payment. I put that, of course, in the first year, and then I spread out the remaining costs over those 11 years. And I calculated our internal rate of return. It was as if, each year we paid all this cash in, and then at the end of 11 years, we got the benefits back, which after paying off the mortgage, $233,000. That makes a big difference. It takes the return from 2.22% to 3.8%. Okay. Now, I mentioned two things. That's the first one. What's the other thing that we can do? Well, as I mentioned, it's tax-free. And so if you want to compare this to a return that you'd have to pay taxes on, like, for example, if you invested in the stock market, you just have to figure out what taxes you would have paid. And my estimate was 20%, and that was based on, I think, the long-term capital gains rate, which is what this would be, was 15% at the time, federal, I'm pretty sure. It's 20 now at the top rate, but 15, I'm pretty sure it was in 2004. Could have that wrong. I think that's right. Someone listening will correct me if I got it wrong. And then I have to pay state tax, which is, I put it at 5%. It's actually a little bit more than that. And so, you just take the 3.80% divided by 0.8, and it gets you your sort of return that would be comparable if you had to pay taxes, 4.75%. So I know I've kind of walked through a lot here, and I could have done it with a lot more precision. I looked at the costs on an annual basis. I could have looked at it on a monthly basis. I could have, rather than spreading the costs out evenly across 11 years, I could have figured out exactly when we made the improvements and exactly when the maintenance items occurred and exactly when we refinanced and had changes in our mortgage. But it's not going to move the numbers significantly. We started with some eye-popping numbers, at least to my way of thinking. They are 190,000 jumping up to 435,000 in 11 years. That just seems amazing. And it certainly wasn't bad. I mean, the as we've seen, real estate prices can obviously go down. But when you actually calculate the returns and you factor in all of the transaction costs, just the transaction costs alone of buying and selling real estate, particularly if you're using a real estate agent, means that you have to stay in the home for a number of years, 3 to 5 years, with normal price gains just to break even because of the transaction costs, both of getting a mortgage and then of selling a home. It's very significant. You add in some improvements that we did, which, arguably we probably didn't get a great return on those improvements. Normally you don't. The maintenance costs, taxes and insurance, of course, interest on the mortgage. You add all that up, and the rate of return is just not great, particularly when you compare it, say, to the long-term returns on stocks of, say, 10%. So now, what's the takeaway? So I've gone through all of this, and what's the point? Well, I wanted to accomplish a couple of things. There's so much talk about, should you buy a home? Is it a good investment? Is it better to buy or rent? Now, I've covered that issue in the past about, sort of my views of comparing buying a home versus renting. And you can check that podcast out, and it's podcast 59. So it's DoughRoller.net/podcast 59. Today was a little different. I just wanted to look, is this a good investment? Now, so here's my take on it. People want to debate whether owning a home is an investment or not. I absolutely think it is an investment. And here's why. When I think about investing in real estate as a landlord, or even as an investor in a REIT, a real estate investment trust, that kind of investing has both a bond component, a bond-like kind of component, and a stock-like component. Let me explain what I mean. when I buy real estate to rent, I view the payments that my tenants are paying me to rent the home as like a bond. It's fixed, at least for the period of the lease. This sort of monthly rental income. It has the qualities of a bond. At the same time, I'm hoping that the value of the real estate rises over time, and in that sense, it has qualities that are, I think, more like an equity investment or a stock. And that's why, for example, in terms of risk profile, I generally view REITs as falling between bonds and stocks, so somewhere in the middle as it relates to risk. In my view, closer to stocks than bonds, but they're still somewhere in the middle. Now, there are a lot of different kinds of REITs. So that's a gross generalization, but that's sort of how I view it and how I view my investments in real estate that I rent. It's got, again, that sort of bond-like quality of the rental payments and the stock-like quality of, hopefully, increases in values of the property. Well, when you buy your own home to live in, of course, you don't get the rental income, but you do have sort of the stock-like, if you will, aspect of an investment, in that you hope over the long term the property goes up. Now, history tells us that over the long term, generally, housing goes up equal to the rate of inflation, which may not be all that exciting, but over enough time, it can produce a good return, given that you're also using this investment to live in. And one thing that I did not calculate in all of this is the fact that we didn't have to pay to rent a place, right? Part of that is because I wasn't comparing this to renting. I was simply wanting to assess, forget renting for a moment, was this home a good investment for us? And maybe comparing it to stocks and that sort of thing. But it absolutely has or is a very important component of your finances if you own a home that you live in or you're considering one. And I absolutely treat it as an investment. Not in the same way as I do the rental properties that are generating monthly income for us. And they have an entirely different analysis for returns. And that kind of investment can be very good. And my experience with rental properties, and in fact, I'm going to do some podcasts that walk through how we buy rental properties. And I'll do the same thing. I'm going to give you numbers. I'll show you the good, the bad, how we've done. But I've been investing with a good friend of mine since, let's see, 2005, and we ended up buying 5 single-family homes together. We've sold one to a tenant. We still own 4, and they've turned out to be very, very good investments. But again, we're getting that rental income every month, in addition to hopefully increases in the value of the property. But here's the thing with home ownership, and I think something that gets lost is that when buying a home, assuming that you get a 30 or 15-year fixed, fully amortizing loan, and you don't get home equity lines of credit, you don't pull equity out of the home in the form of cash to spend on things like vacations and fur coats, it is a forced way to save. And I think for many people, that kind of forced savings is very, very helpful. Now, can you rent a property and perhaps, depending on where you live, and save the costs that you'd otherwise have to spend if you bought a home, invest it wisely and do well? Absolutely you can. Of course you can. And many people do. But here's the thing. Many, many people don't. And owning a home gives you that built-in way to save money as the home increases in value over the long term, and of course you pay down the mortgage. The other very significant advantage is that, again, they're subject to certain limitations. The gains that you'll realize when you sell the home are tax-free. And if you were to stay in the home and then eventually, on your passing, it were to go to your loved ones, there are some tax advantages to that too, because typically you get what's called a stepped-up basis. Without getting into all the details there, I dealt with that with my stepmother when I was handling her estate. But in this case, for example, if it had been bought at $190 and then the owner passed away and it was then worth $435,000, and let's say their children inherited it, for tax purposes, they would get the stepped-up basis. So it would be as if the cost of the property were the $435,000 or the value of the home at the time the individual passed away. The point is, and I don't mean to dive into all those details, the point is there are some significant tax advantages to home ownership. Now, we can debate as to how long those will remain, but they've been a part of our tax code for a very long time. That the tax-free nature of the gains on a home, I think, oftentimes get overlooked. You hear all the time about mortgage interest is deductible. Real estate taxes are deductible, again, assuming you itemize. Significant, but boy, I'll tell you, the fact that the gains are tax-free, again, subject to some limitations, is huge. And so I personally think for a lot of people, home ownership is a good way to build wealth. It shouldn't be your only way. Obviously, you should be saving for retirement in tax-advantaged accounts like 401ks and IRAs, and even hopefully investing even beyond that. But I think home ownership can be a good part of that overall picture. However, part of my goal today was to kind of bring some sobering numbers to the equation. When you factor in all of the costs and whatnot, it's an okay return, not an amazing return. Sometimes it just looks like it is. Anyway, that was our experience with our first home. I can tell you, by the way, our second home we've lived in 10 years, and actually it would not do as well. If we sold today, I'm confident that we would not have the compound annual growth rate that I've walked through with our first home. Of course, we went through a very bad real estate market, as you all know, and we've started to recover, and I think we're in that process. But I think when you factor in the improvements we've made to our current home and all of the costs and everything, frankly, I think we'd be lucky to break even. And maybe we would, but it wouldn't be much more than that. And we've lived in this home for 10 years. So I guess that's the other side of this, and that is there are no guarantees. You can go through a real estate market that is pretty rough and can take a number of years to recover from, and I think that's where we are now. I think if we stay in this home for, say, another 10 years or more, I think we'll do just fine. But again, the compound annual growth rate, I wouldn't expect it to be much more than what I walked through with our first home. It's certainly not going to be 10% like you might get from stocks or from real estate that you actually invest in as a landlord and rent out to tenants. So anyway, that's my experience with home ownership and kind of a look at our first home and how I kind of assess and view that home as an investment. Like I said, I'll leave these numbers in the show notes with some screenshots of the Excel formulas in case you're, really bored and you just want to check them out. Maybe some of you are into the numbers, and I'll leave those in the show notes. You'll find those at DoughRoller.net/podcast76. Podcast 76. As always, if you have any questions, don't hesitate to shoot me an email. dr@DoughRoller.net. I love to hear from you. Hey, everybody, have a great day. And remember, the best thing money can buy is financial freedom.